tuning into the Rask network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew, Meredith, how you going?
Pretty good. I always see that intro or the promo intro video, and you look a lot different there.
What are you trying to say? That was some...
Is that like 6 years ago, 5 years ago?
So for anyone that's listening on a Saturday morning, we're just going on video live on YouTube, and there was a disclaimer video. So that was about 3 years ago.
Pre-beard?
You can age so quickly when you run a business. It is unbelievable. Also, when you have like a crisis and you go from your 20s to your 30s during COVID, you just don't get to celebrate the same way. So I've got a question for you. I was having breakfast with a mate of mine, Mr. Ryan Newman, CFA from Motley Fool the other day, and he just wanted to confirm something that I needed to confirm with you.
Oh,
which was
hi, Ryan.
You're not a real doctor, are you, doctor?
No, I'm not. I do hope to one day get an honorary doctorate, like Shaquille O'Neal or multiple basketball players have, but no doctorate, no.
So, like, you would get one for like predicting interest rates or something?
Something like could be anything, yeah.
Yeah.
Services but you do... to financial economic forecasting. I'm not sure.
Bill Mitchell's going to give you a run for his money.
Cap it again,
yep. I can see you in all the regala and everything like that. In other news, Sam Altman fired, then comes back. All the while, I just saw an article this is from The Guardian, and we're recording this on Friday, the 21st of November, 2023. This is from The Guardian, who says...
You can't look away for long at that. That was basically, he was gone, then he was back within 24 hours.
Oh, yeah.
Hours.
OpenAI was reportedly working on an advanced system before Sam Altman's sacking that was so powerful it caused safety concerns among staff at the company. The artificial intelligence model triggered such alarm with some OpenAI researchers that they wrote to the board of directors before Altman's dismissal, warning it could threaten humanity. That was from Reuters. The model called Q-Star was able to solve basic math problems it had not seen before. That's according to the information, which added that the pace of the development behind the system had alarmed some safety researchers. The ability to solve math problems could be viewed as a significant development in AI.
This is what they called, was it artificial general intelligence, where computers can think and reason for themselves?
Yeah.
So Sam Altman was the CEO of OpenAI, which runs ChatGPT, at 49% owned by Microsoft. Did you see what happened there? The board pushed him out. He basically signed to join Microsoft. 500 staff and programmers also agreed to join Microsoft. And then this whole thing kind of reversed and installed him as CEO within 24 hours.
Pretty crazy stuff.
Definitely. And the future of humanity rests on it. So hopefully they're making the right decision.
Well, in those 500 people we trust.
Forecast on this one?
Yeah, let's do a forecast. What's your forecast?
Everything will be fine.
Okay. Oh, Jesus. Yeah. We want you to say the opposite so that you're wrong.
AI. All right. Yeah. This is the beginning of the end of humanity.
I've got a hypothetical that I might catch you with. I heard while I was watching a show the other day. If you have to have a choice between going to maximum security prison for 1 year or going for as long as it takes you to solve a Rubik's Cube, which would you pick?
Rubik's Cube, definitely. It's not that hard, is it?
How long would it take you to solve a Rubik's Cube?
I don't know, like an hour. I think. I don't know. I think there's like 12 moves out there for a Rubik's Cube that you can work out pretty quickly if you practice.
I'm going to get you a Rubik's Cube, and if you can solve it in under an hour, I'll go to prison for a year. How about that?
My problem is staying concentrating on it for an hour. I give up for a while. And then Google how to solve a Rubik's Cube.
No, you can't have any aids, though, of course. You got to go in there, solitary confinement, just in there with your Rubik's Cube in the office. I'm going to do that, and I'm going to bring in a Rubik's Cube in before the end of the year. If you could solve it under an hour, I'll do something ridiculous.
Can't be that hard. Well, I pretty much got a solitary confinement in here, so it's
In
beautiful.
the studio, yeah. So, what's news? I see that CBA did something.
CBA had a report. We had Origin with a bit of a takeover, some weird 11th hour reverse takeover idea. We had bank reporting since we've been a few weeks since we've been on, so a lot has happened. Kathy Wood came out and said we're looking at deflation, rate cuts. Thanks, Kathy. Not this year, unfortunately. Telstra reported, Nvidia reported, Nvidia. I still haven't worked out how to pronounce it.
All of the above. Okay, where
do we start?
Well, why don't you give us, as you go through, why don't you give us a score? Well, obviously Origin's not a result, so maybe we'll start there, but then you can give us a score A+ through to fail of the others.
Yeah, perfect. So you saw what happened to Origin. Brookfield and EIG are trying to take over Origin, which owns retailers, energy retailing, Octopus Energy, one of the biggest UK energy suppliers, as well as coal-fired power stations here. And Australian Super, the big super fund, owns about 17% and is blocking a takeover deal that's been happening for about 12 months. They had a vote planned for yesterday, and it was cancelled or deferred at the last minute because the bidders offered a new deal, which would allow Australian Super to keep an ownership in the company once it went private, and then they offered a decreased price as an alternative, but a very clear offer to split the business up at the same time. So it's kind of showing the power that these huge pools of capital have in markets now, that Australian Super is essentially determining the future of Origin. They want to take it private because they think it needs more capital to move away from coal. And Australian Super thinks it's undervalued, and there's so much potential in that business.
So what's your prediction?
It doesn't seem great we held it for a while and got rid of it when the takeover first came out, just for this exact reason. There was probably an extra 10% upside in it, but the uncertainty that comes with these type of deals, it wasn't worth hanging around for. I want it to get done, but it seems like it's not going to, unless Australian Super gets a significantly increased price. It's not going to happen.
Okay.
So
next up,
B. Not great for shareholders at the moment, but
not great for shareholders. So that's okay. CBA.
CBA was solid, but there's some concerns about net interest margins. Profit 2.5 billion, pretty flat on the prior year, and only 1% up on the first half. And like most banks, interest margin is continuing to where they make all their profit, what they charge for loans versus what they give in term deposits, isn't expanding as much as people thought. So we all thought that higher interest rates would lead to bigger net interest margins, but still performing reasonably well. So I think it was probably a B+ for CBA. We go on the ABC scale, or we
sure, yeah. B+.
Feels like a B+.
Yep. A pretty good result. Business lending is still accelerating from CBA. They're really focusing on this recently because everyone knows this, but business lending is a much easier way to get wider net interest margins because you can charge more. And as long as you get the kind of risk modeling down pat for the businesses, you can make a lot more money as someone who lends money to small business.
The small businesses are underbanked or underborrowed too, usually.
Yeah, exactly. Because the big banks have such a crappy lending system for small businesses. We had Joseph Healy and David Honoray on the show earlier this year from Judo Bank, the founders of Judo Bank, ex-NAB. And they just don't have opportunity to, small businesses don't have opportunity to go to a big bank and say, hey, this is what I'm doing. Will you help me out? Because it's all based on, do you own a property?
Yeah.
So it's good to see them accelerating there. Probably makes more sense. Flat operating income. Yeah, I'd say it's, B+ is fair enough. And not the arrears that previously people were expecting. So, it's pretty joyful for a lot of us.
It's like, I think it was 12 months ago, everyone was talking about the mortgage cliff, and we've gone well past that, and it never quite happened. But we talk about it all the time. There's clearly people that are in pain and feeling the stress, but there's also a cohort that's just getting more income from the investors that they have, or haven't eaten as much in their offset account. I did hear, so we're part of the bar. We just had an update from them this morning, and in September there was a significant fall off compared to the prior year in terms of revenue, or in terms of sales, so cocktail and food sales.
Yep.
And that was apparently it was across the industry in September. Not sure exactly what it was, but maybe that's the cost of living and interest rates starting to hit the belt.
Yeah. Well, it probably is.
$30 cocktails.
How many, like at the bar beneath Driver Lane in Melbourne, if you're in the area, would it be predominantly people under 60 or over 60 that go to the bar?
Under, definitely.
Yeah. Well,
Yep.
There you go.
That's a loaded question.
All of us with a mortgage are like, yep, we haven't been out in months. But that's interesting. That's a really interesting anecdote.
Yeah, and it's like having that exposure is, and you can see, and the days of trade in the city are quite different. We're also talking about heat maps of people in Melbourne, and when you're not that you come in much anymore, but Thursday is Thursday and Saturday are the biggest days in the city. It used to be Friday, so Thursday's become the new Friday. Then apparently Monday is incredibly popular. So more people are choosing to work from home at the end of the week. Seeing less foot traffic.
Okay, interesting. So one of the things that people know you for is an alter ego, interest rate predictions, but also calling Telstra as a buy. I think it was earlier this year. You went on the Australian Finance podcast, one of Australia's biggest podcasts, and you went on there and you said buy Telstra, and there was a few eyebrows raised in the room that day. What's the latest?
Has it moved?
No, I think last time when I was like, come on, man, you got to come up with something better than that. But it rallied through that.
It did rally from to almost 450. Now it's back to 380. So if you sold in July, you're great. Plus you've had dividends. You probably broke even in dividend terms. Yeah.
So basically what you're saying is if people acted...
Don't take my advice. Kidding.
take retirement and financial advice from Drew. But
what's the return of the ASX 200 year to date?
Dividends?
Do you want an over under?
No, I'll ask for dividends or no dividends. But you're going price return ASX. Yep. I would say -1%.
+1. So you haven't underperformed the ASX that much.
Yeah, okay. Yeah,
if Telstra's down 1 or down 4 for the year, and that's pretty surprising that the market's only up 1 and it's up, but then it's almost only up 1 given how strong it was earlier in the year. And there's probably this linking to that AI story. You don't know that I hid some numbers on the notes that we've got here.
Yeah, you hid some numbers using AI.
Put them in different font, so you can't see them. Owen doesn't prepare a lot for these, as we've worked out. He puts like 3 dot points. I put 400. So how much has AI powered the NASDAQ this year? We kind of check in on this every few weeks or month or so. What's the NASDAQ 100 up year to date to today?
Year to date, NASDAQ 100, including the Magnificent Seven?
Yeah. Over under?
No. 36%.
47.
Jesus. But I've been hearing if you exclude the Magnificent Seven from the S&P 500, you're up like single digits. Include them, you're up about 20.
Yeah, that's like anything. You exclude the best ones.
I know. I love those things. I always think that to myself. I'm always like, yeah.
If we did not,
great.
But we did.
Yeah.
But we did.
Like those people that always say, oh, well, if you just avoided the 10 worst days over the past 10 years. And you're like, what? Who does that? Like
impossible.
Yeah. Anyway, yeah, cool. What else you got for me?
We had an interesting one was...
Oh, it was Telstra?
It was more of an update. Yeah, so it was pretty flat. Nothing significant. But returning to profit, a little bit of growth. They probably missed the time in terms of selling their infrastructure assets. Now the bond yields are higher. But they're just doubling down on the things they're good at, digital infrastructure. And they're expecting earnings to be, slightly better than this year. So, but again, it's like there's a role for different companies in every portfolio, and this is one that essentially you treat like a bond. That it'll trade in a range over time, but it's basically paying out most of its profit as dividends. So, and it's pretty well secured dividends.
I was talking to actually, public service announcement. If you hear this on Saturday or Sunday, can you please let me know if you want me to ask David Lamont. He's the CFO of BHP Billiton. I'm catching up with him on Wednesday for a podcast, for a bit of an interview in the BHP boardroom. So I'm just going to be in there. Don't know what I'm going to be doing. I don't know what I'm going to be doing in there. Probably interviewing him, I guess.
CEO of BHP.
CFO.
CFO. Oh, sorry.
I push this here. I'm like, come on, where's Mike at? Like, what are you doing? Australian Investors Podcast. Bring it on. I don't know.
They want Andrew Dermott if you're getting.
I did name drop. I said Andrew Dermott has been on the show before. He could make an appearance. But if you want to, we've had some great suggestions for questions sent through on Twitter. So help us out. Just send in some questions. You know how to get in contact with us. Send us your questions via the link in the show notes. The other thing I was going to ask you is a bit of I'll give you an over and under. You always give me over or under. So I'm going to give you over or under NVIDIA's return this year, 2023, over or under 200%.
Just under.
240%.
Ah, I thought it was like 190. That's a
1.2
and a half.
It's a $1.2 trillion business now.
That's crazy.
It's unreal.
But then you look at the numbers that they pumped out this week, and it makes sense.
Because the inflection is insane.
So revenue soared to 18.1 billion from 6 billion a year ago. So threefold increase in semiconductor sales for AI, essentially. And the quarterly sales were a new record, 13 billion. It's just like and this is talking about the initial part, the initial growth of AI, where they're saying this could happen, 30, 40, 50% growth in AI and in semiconductors for the next 5 to 10 years.
It's incredible. Like the transition of the business over the past year, like everyone has known. I remember David Gardner from the Motley Fool talking about NVIDIA. 2013.
Well, it was out of favor during the pandemic too.
This is like, I feel like everyone has always thought that this time would come. Like at least people that are in like the technology industry. But when it has finally come, I think it's still blown everyone away how incredible it is.
And it's a massive tailwind. It's hard to see it stopping because this is just the initial part of that. Plus they're not just doing AI. They're in every other piece of high performance computing power in the world. So I remember in the pandemic, there was a shortage of chips and they couldn't produce enough chips and everyone was selling them off. Oh, they're a cyclical company. I think they were significantly lower.
Those are probably the same people that were buying Zoom stock when it went up 600% and then went down 800.
It's not going to be, it's a secular change, not a cyclical.
It's actually just incredible. I think the only thing I can do to rationalize what's happened is effectively the 500 staff from OpenAI hadn't got their full position in NVIDIA yet. So they didn't want to release this rogue AI on the world just in case they didn't have enough economic incentive to benefit from it. So the other news, which is the thing that probably everyone loves to hear about, is HP reported its results, Drew.
Yeah, HP not the most interesting company. Sorry, Hewlett Packard these days. The interesting part is NVIDIA was that the stock fell, not significantly, but they weren't happy with threefold increase in revenue. It was the opposite for HP. So mature company revenue fell by 6%, and basically sales across most of their business lines were falling as well. Printing, personal computing, but they did say they're going to have their first AI-powered PC midway through next year. So maybe this is a leg up for a company like that to get some of that J curve in AI-powered growth. But who knows? I can see a lot of product coming out at the same time.
Yeah, fair enough. So as we transition now, we've got some hypotheticals. I struggled to come up with hypotheticals this week for Andrew / Drew. So if you are listening and you do have some hypothetical questions that you would like to put to either of us, you can use the show notes to do that. You just hit the Ask a Question button and the link, and then hit the button that says Australian Investors Podcast. Actually, before I get to these, I did catch up with Clayton Hatch from Pro Medicus for a lovely coffee the other morning down in Richmond, Victoria. Clayton Hatch is the CFO of Pro Medicus, which we all know. The ASX is top performing company, I think, still over the past 10 years. Recently hit an all-time high. They had the AGM. The business is still just kind of ticking along, and I came away from that chat with Clayton just thinking it's a wonderful team. It's really focused. Its culture is actually what you'd expect. A lot of the times, the businesses that you see and they talk about culture, they have things printed on the wall as you walk in, of nice photos, or they call their boardroom the Buffett room or something like that. It's not always the case. So it's definitely, every time I've spoken with them, it's always been on purpose. They're focused people who just really care about the product and the community they serve. So that was really reassuring for anyone that follows the company closely as I do. So my hypotheticals for you, Drew, are as follows. What has running your own business taught you about investing in companies? And the reason I bring this up is we all know the quote from Warren Buffett, which says something along the lines of, I'm a better businessman because I'm an investor. I'm a better investor because I'm a businessman. What has running businesses taught you?
As you said, culture, but culture is so broad. I think it's the people and the teams that are within those businesses that it always becomes about the people. The leader, and I sat next to there's a group called Kane Anderson, so a big real estate group. I sat next to the CEO of that company for dinner a few weeks ago, and it was about the leader getting his team to grow rather than the leader being the key driver of that business. So how do you delegate, or either delegate authority or have leadership coming from below rather than relying on one person at the top? If that makes sense. And I was talking to someone else yesterday about this, which is the ability to have a long-term strategic view and a focus on that, rather than do what happens a lot in listed markets, which is we look at the next quarter and 6 months, and in politics, we're worried about the short-term news cycle. So how do you set a strategic long-term priority and actually stick to it and eloquently, have your teams buy into it at the same time? I think, and that's how, as we run multiple businesses, how do you stay on track and make sure that you're heading in the right direction and don't, lose the forest for the trees? Is that the right one?
Sure.
Which is to understand where you want to be in 5 or 10 years and make sure everyone knows that as well.
Yeah. That's fair enough. I would say something that I've taken away is that the more I've run a business is the more I realize that it is just absolutely essential to either be a manager or a leader in a business to understand and to be able to forecast how a business might run. Like, it still bamboozles me that some of these analysts that are at top shops have never ever had like real operational experience, because you just realize how unbelievably difficult it is to do those things like culture, to move a business. And then on top of all that, to try and predict it from one quarter to the next, that would just they try and predict it like specifically.
Yeah.
Impossible. Absolutely impossible. So you can have a general sense of where businesses are going, but that would be one thing that I've learned. Okay. Another one that we get a little bit is more around the educational side. If people want to move into the industry, Drew, we can be maybe a bit quicker with this one. If you had your time again, would you have studied the Certified Financial Planning, the CFP designation?
Probably. I think it was kind of required when we did it, but it didn't add significant benefit. And I think a lot of this is that it's run by an association. You have to be a member of that association to have that authority. I'm an SMSF specialist advisor as well, and that's like when you're looking at retirement, that's very focused on SMSF, super law, tax law, and very relevant. I think the CFP wasn't necessarily that valuable broadly, and maybe that reflected in the fact that so many advisors left the industry when the Code of Ethics came out, even though so many had the CFP mark as well.
Is there another profession you would have chosen?
You know what I like these days, anyway.
Interest rate predictions.
Writing.
Oh, okay.
Writing
my bad.
interest rate predictions. I know journalism's a tough kind of industry to be in, though. So the constant turnover. Part of that is what you do.
Yeah.
But this ability, I've got this for some reason ability to write quickly, maybe not that well, but quickly,
No,
get my thoughts down and maybe kind of not and translate hopefully complicated concepts into more simple explanations. So writing for sure. I could sit in a dark room and write thousands of words after thousands of words.
Okay, well, don't do that because that might be a bit weird. But I think that that is actually a tremendous skill, the ability to write. Like we've spoken about it so much on the show, the ability to write for anyone that's like interested in investing or running a business is to put your thoughts down, even just for like journaling. I find that I would say, if I could choose a personality trait of something of a person that I'd want to work with consistently, it would be someone who journals.
Yeah.
Because it just brings like perspective, calmness, lowers anxiety, allows introspection, like those types of things. And for that reason, like writing is actually a very kind of like therapeutic thing to balance out your behavior. So that's cool. Okay, great.
Out of your own head most of the time too.
Yeah, I didn't expect you to say that, to be honest. I didn't know what I'd expect you to say. Maybe like professional NBA player. I don't know, something like
5'8". There's never a chance.
I don't know. I don't know. You could be like some of those guys. There's one guy from the Rockets that's pretty small. He's great.
We can't skip over Kathy Wood signaling that we're in a deflationary.
Oh, of course.
potential
Go
trend
for it.
here.
Yes, tell us. Tell us what this high growth equity investor has to say about stagflation.
The deflation trend's begun in commodities, so commodity prices falling, and that's starting to feed through. So it could be in energy and starting to feed through every part of the economy. And next, it's going to airline prices because we know that one of the biggest contributors to inflation in Australia was people going to Europe during summer, or European summer, and car prices. Both of these things that were in short supply after the pandemic, and they're kind of disappearing. So she thinks Fed's gone too hard, and they'll cut off a rate cutting program next year. Although kick off, sorry.
Good on her. So,
and we know that the first cut usually in these environments, if something happens, is 50 to 75 basis points in one go. So I could get all of my hikes reversed in one.
So you're still hanging on, man. You're still hanging on. We've got one more meeting before the end of the year.
I just need to create a liquidity crisis between now and next week.
Well, you could be right.
Probably could.
Who knows?
Yeah.
Yeah, well, just say something about property or something.
Someone being insolvent or something like that. And
I mean, realistically, I love those headlines. It's always good to come out and say something. When you're a person like her, maybe you have a very strong influence and you can say things and people pay more attention to it, and therefore it reinforces your status or when we just come on and say things, everyone's like, yeah, whatever, those guys. But if you think about it, the US economy has actually been extremely resilient, I would say.
Most have, apart from Europe. Basically, Australia's been pretty resilient too to what's happening.
Well, think about it. Everyone was predicting, I think Chris Joy came out and predicted like 26% annualized falls in property prices. I don't think that happened.
Chris all the time, don't we?
Oh, poor Chris.
Maybe annualized.
Maybe if you annualize it, the daily rate. But at the end of the day, like that hasn't happened. These economies have been very resilient, very strong. And there's always something to worry about. But I think like they wouldn't be cutting rates unless the economy was racing, down a slope that it can't come back from. So I don't know. We'll see. We'll see what happens. In a stagflation environment where inflation is persistent, true, but growth is slowing, what do you invest in? Gold?
Stagflationary environment, generally anything that has a link to inflation. So something like infrastructure, real assets that have a high replacement cost as well. But I'm in the camp that inflation's falling, and then eventually growth will turn, and we're probably going to need to cut rates at some point. So, but yeah, stagflation is scarce assets really, and less cyclicals. And then you'll always say quality and pricing power.
Quality and pricing power sounds pretty good.
Like tech. Who performs well? Tech.
Yeah,
if you've got a thematic tailwind.
To be honest, like I spoke about this with Cameron Gleeson from BetaShares during the week, sponsor of the show. Thank you very much.
Name dropping a lot.
Well, basically, my job is to speak with people, which I'm very blessed to do, Drew. I'm very, very happy to do that. It's very lovely. I basically, I'm very blessed, and I do. It's not missed on me that I get to speak to these people, and I get to do it on behalf of the community, which is wonderful. But Cameron was saying that people have like looked at the US equity market returns, like you mentioned, NASDAQ before, S&P 500, the Dow, whatever, however you want to slice it. And they're like, well, it's performed very well over 10 years. I think the NASDAQ's returned 20% compound for 10 years, right? An index, 20% per annum. But the price earnings ratios and the way you value these markets, in some instances, in some of those years, it actually fell because the earnings are growing so fast. And so for a lot of people out there that are listening to this, what it basically means is that even though an index goes up, it can actually get cheaper over time because the company's profits accelerate.
Yep.
And so we've seen that happen at a time when interest rates are going up. So
same thing happens here, where the results of our BHP and CBA mean the market has a significantly lower PE ratio than what the rest of it's saying.
Yeah, but that's also why the Australian market has significantly underperformed the US market, because over there's no tax incentive to withhold, to pay out all your dividends, and you've got to reinvent yourself. You've got to do share buybacks. Whereas here, you don't have to do any of that. You can just pay fully franked divvies. Let's not get into that dispute. So anyway, we've got some questions to get through, Drew. As always, we don't know your personal circumstances, your needs, goals, or objectives. So always speak with a licensed and trusted financial planner, like say the one sitting right across from me here, which is Drew Meredith, and the team at Wattle Partners. You'll find a link in the show notes to speak with a financial planner. It says financial planning, and then there's a link. So if you click that, that's how you do it. Otherwise, you can head to the moneysmart.gov.au website. If we mentioned ETFs, funds like super funds, products like insurance, be sure to read product disclosure statements or the PDS and target market determination on some of those things before you acquire or invest in those products. Past performance, not indicative of future performance. Also, if you write in with a good name, you get voted the number one name for the week. You get a free pass to the Value Investor Program. Usually $499. It's yours for free if we select your question. Okay, casual rascal. They haven't started off well. We need full-time rascals. That's what we need. Hey, rascals. I haven't heard you talk much about emerging markets, but I know you prefer active over passive. Do you consider emerging markets core or satellite? Is it, quote unquote, generally something to hold long-term, i.e. decades, or something to monitor and assess on a shorter-term horizon? Thanks, guys. Drew, generally speaking, EM, core or satellite?
It's a myth. I don't know. I'm stealing your notes there. Cora, I think. It's clearly a satellite. The risk profile of emerging markets is significantly higher than the Magnificent Seven, the SP 500, even the ASX 200. You could say Australia is an emerging market if you want to get some headlines, because they're linked out of China. Yep. But we view a core as being, incredibly highly diversified across sectors and super low cost, and emerging markets are kind of less diversified and higher cost generally to access, but they're also much more variable and cyclical. And as we've seen, emerging market returns are heavily driven by currency and what's happening in the US and around the world as to how the equity markets perform.
Yep.
Core satellite for you?
I think if it's in your core, it's got to be a very small allocation.
Yeah.
I think we've seen in the last 5 years, we've seen this proliferation of robo-advisors or fund managers, like multi-asset fund managers here in Australia, who, even overseas, to be frank, some of the big hedge funds in the US do it as well, where they kind of think that all of the economic growth is coming from Asia. And they would be right. Over the last 30 years, China in particular, heaps of the economic growth has come from them. But how's their stock market done? Right?
Nothing.
Yeah. It was okay up until the mid 2010s. But then, we started to get more regulatory environment, a shift, a pivot in the economy, a pivot in the types of companies that were benefiting. And ultimately, you got to firsthand look at what it means to be investing in an emerging market. We saw Russia was basically cut from the indices. So I would just say, if it's going to be part of your core, it's got to be a very small allocation, like sub 10%, sub 10%, even for a high growth investor.
You're always looking at these as long term too. You might have a tactical view in the shorter term, say 2-3 years, but equity allocation to this, you want it to be 5-7 year view.
Absolutely. One of the things that is quite interesting about this, Matt Story, who was working on our Rask Invest service, he did a bit of analysis into this, and basically it shows that there's kind of a myth around EM in that a lot of the economic growth doesn't translate into earnings growth, and that's a key fundamental thing to understand. Is like it just simply doesn't translate, even though the country might be growing. Per share profits not
for the
reflective
market,
of that.
For the index. Yeah. That's why we've always, they're under researched and it's super inefficient, but you have to go active in these places because you want the companies that are growing earnings. You don't want the index. You want to know which parts of the economy and those and pick and choose the ones that are best positioned at any given time.
Yep. Amen. Alex writes in, I assume that's the real name. Do you provide full transcripts for interviews? Thank you very much. And they reference the Brett Kelly episode. We don't do this anymore. We did in the past, Alex. You can use a service like Otter or Rev.com or something like that, and you can just put in the URL of a podcast or a YouTube video, and it actually does a full transcript for you. So you can use one of those services if you like. There's also captions that are available on YouTube, closed captions, if you're hard of hearing or something like that. So check that service out, Alex. So Costo Lee writes in and says, "Gents, I'm in my early 20s and like many at the moment, still living at home. I have a stable, well-paying job and am fortunately in a position where I want to start putting 20% of my paycheck into investments. That's not including my savings. I have, quote, dabbled in stocks and ETFs, but want to start taking it seriously. What advice would you give an early career professional who currently has a large amount of disposable income and want to get a head start building wealth for the future? For example, if you're young, is it too early to begin putting money in super? Paying off the HEX? Any resources or tools would be great. Thanks a million." I assume that means Costo is going to send us $1 million,
Let's hope so.
which is fine. You go first if you want.
I mean, the first one is a good start. I mean, you're living at home and you're putting your savings or your excess income to something productive. So whether it's ETFs, term deposits, shares, super, you're in the right direction. Everyone, the lesson everyone says is, what did they wish they did? What mistake did they make when they're investing? And they didn't start soon enough. So that's step one. I mean, generally, in your 20s, there's little benefit in putting money into superannuation at this point. The conditions of release mean you're not going to get any access to it until you're at least 60, maybe 65, maybe longer. You'll probably live to 100, which is a long time to wait. And for that reason, putting investments outside superannuation generally makes sense. I know you got a HEX question there. And this one always gets. I know the finance podcast, and I know the guys at Equity Mates have had different views on this too. It just depends on what your objective is. So if you've got a HEX or a HELP debt, which is student or uni debt, it's going to impact your ability to borrow to buy a house. Yeah. But at the same time, it's incredibly cheap borrowing that you couldn't get now because you don't have any security. So there is a benefit in not paying it off, and then likely paying it off if you need to borrow in the future, and it's restricting that.
Yeah, I think a HEX debt should be paid off or at least should be considered to be paid off near the time you want to borrow, because the thing that makes HEX debt hard if you're borrowing for your first home is it's not that there's the debt, which obviously would reduce your assets and liabilities column. It's actually income statement, your personal income statement, because HEX obviously applies over 49,000 or whatever it is these days. It takes a big chunk of your income away from the servicing ability. And so that's why basically every mortgage broker would like it if you didn't have HEX. I would say the best advice I got early on was to not dabble in stocks. Yeah. I think if you think about Drew's comment about the number one piece of advice is start early, the corollary, is that how we say it? To that is that if you did start early, you didn't just go into specky stocks and blow yourself up, because then there was no point starting early anyway. I think the best thing to do would be to follow that core and satellite approach. Generally speaking, this is what we tell everyone in the Rask community, is put 80% of your money in low-cost, boring ETFs and put the other 20% into your brokerage account that is responsible for your share trading. I separate those out.
That's because ETFs are broad-based.
Yeah, and you're going to capture the market returns, which over the long term, is going to average 5 to 10% save a diversified portfolio. And that's your plan B. And as your skills and knowledge increases, because you're using that other 20% to learn about businesses, to go and explore the balance sheet of NVIDIA, to find out what makes the Costco business model so fantastic, or why Telstra is a horrible business, and I can't believe it got recommended on the Australian Finance Podcast. So these types of things. Once you go and figure those things out, you can then build your confidence and your knowledge and your humility too. But one final thing is I wish, Drew, when I was younger and starting out, this is maybe just, I wrote about this last week, was I just wish that I wasn't so anti-property in the early days. Because I grew up in finance
Everyone does in our generation because
class.
we all
And
should have bought earlier.
yeah, I just wish that like in the early days, I was like, oh, Warren Buffett says businesses, and I was like, I wish I took my money and had a bit of more of a personal finance understanding, like around tax and around loans and that type of thing, like not just focused on stocks. Because I would have if I had my time again, I would have taken my share portfolio, bought a property, paid down some of the equity, redrew that equity, and used that to buy shares. I would not have bought shares directly.
I wish I understood interest rates better because essentially that's what's driven property prices for the last 20 years. If I knew that interest rate falls, we're going to make my property worth triple the amount in 15 years. Yeah, we all should have leveraged up as much as we could. And a lot of people did. Like baby boomers, everyone thinks it was easy. They just took a whole heap of risk.
Yeah,
and
they did
leveraged
take
up
risk.
and they got the benefit on the other end. And then bond yields and interest rates were central to that.
Yeah, absolutely. So same with like population growth here in Australia. Joe Blow gets FOMO. Says, "Hi Owen and Dr. Derrimouth. It's a shame I don't have anything around my name. It's just Owen. Hi Owen and Dr. Derrimouth. I hope you're well. I always hear you guys talk about various asset classes, diversification, etc. Although it sounds fun, I'm very early in my career and don't have much to invest right now. I also want to buy my first house in Sydney at some point, which they say is bold. So my question is, how many asset classes should someone be focusing on, and which ones? It's obviously a general question. We don't know your circumstances or your objectives for the matter, other than the house which you've given us, which, we would always caution anyone from investing money that they need for a house deposit. At least a couple of years in advance, you want to be making sure that money is safe. But anyway, like how many asset classes do you actually need, Drew? Like you got Aussie shares, US shares, European shares, emerging markets, India, fixed income, like government bonds, US bonds, like gold. Where do we draw the line?
I think in this case, if you've got a property, you're going to do a property purchase soon, then you don't want to be considering any of them. You just want to be, putting it in cash and getting as much low risk return as you can. If you're younger, like the last person in the 20s and looking for growth, well, it's pretty. Just don't overcomplicate it. You can go from incredibly broad, like we're talking the S&P 500 or the ASX 200, so Australian shares and US shares, and you can go so niche and so narrow and granular, it's ridiculous. But I don't think you need to go beyond for a long period of time. Aussie shares, global shares, and then maybe some so some less correlated things like property securities, so REITs. Probably that's an old version of that. It's my birthday this week, so maybe I'm just getting a bit old, long in the tooth. And infrastructure, and you can access all them through ETFs, active funds, very easily or directly as well. I think, but they're the key growth assets on a listed version anyway.
Yeah, yeah, absolutely. I would say Aussie shares, and when I say global shares, I actually mean US shares. I actually think US shares. I take a preference to US shares over all global shares, to be honest, because of the Americanism, kind of American exceptionalism. I kind of believe in that, to be honest. So I would have Aussie shares, US shares, emerging markets in, like we said before, in the satellite, and property for a young person. So in this case, like in most cases, it would be property, Aussie shares, US shares. Then going down the list, I'd have some cash. As a young person, you can probably put that in an offset account, but then eventually you want things like AAA or cash products, and then maybe some fixed income as you approach retirement. That's probably the starting point. Anyway, we've got time for a couple more quick questions, I reckon, Drew. Just real quick. Maybe we'll just finish with this one, which is quite. I love the name, so this is probably where it's worth finishing. This is the questioner's name. Here lies the prediction of rate falls in 2023 by Dr. Andrew Derrimouth. Beta Shares has come out with its Beta Shares Direct platform, they say. They have an autopilot feature, where they construct a portfolio for you at a cost, but they advertise that if you can buy/sell any ASX listed ETF for free if you don't use their autopilot feature and just do it yourself. Would this be worth the effort to save in brokerage? Drew, Beta Shares is obviously a sponsor of the show. I'm going to make that very clear.
I actually haven't looked that closely at this, but generally my view has always been if the product costs nothing, you're the product. Is that the word?
Yeah.
That,
I think
when
it's
you're
a
getting
patsy at
something
the
for
poker
free,
table kind of thing. Yeah.
yeah, that if you're getting something for free, you're paying for it somewhere. I'm not sure if that's the case here, and they're clearly that. So Beta Shares is making the decision. They've done incredibly well getting advisors involved, in recommending ETFs. That's where a lot of their market growth has come from, and this is going directly to retail investors and building their relationship with them. I mean, there's so many options. It's more about finding one that suits you, and it's probably good for ETFs, but then restrict you if you want to do direct stocks at any point. And as you said, there's a multitude or multiple platforms you use for your trading.
Yeah, I think so. I think I think you don't have to have one platform. I think that's the key thing. I always like to know the details of the types of platforms that are out there. In Australia, we have a very unique system known as the chess model, which is where you get your own number that's identified against you with you at the ASX. So that's something that I do like to see. However, you don't get a lot of the features for low balances that come with that model because it can cost a little bit of money. So I would say like you can test drive it if it's free, right? It says autopilot in the name and it's free, so you can test drive it. And so I don't make decisions based on fees anymore. That is, as Drew just said, I do not. To be honest, the investment industry is, I think, well past that nowadays. I think if people still make decisions based on fees alone, of course we're finance people saying this, but if that's the only thing that you think about, then I think that's going to end up costing you. It's like people that only believe in index funds. Like why constrain yourself to something that may or may not always work? And I just think go and check it out. There's an ad for the thing on the show. So you may as well go and check it out, see what you think, give us your feedback as well. I'd love to know what you think. I love any of these automation features that allow people to dollar cost average. I actually do like these things because it just encourages good behavior as opposed to the old, brokerage accounts where the first thing you log in and see is a daily price chart or some candlestick pattern, or that's just stuff designed just to make you lose money over the long term.
Yeah.
So keep it simple. At least that's for me. I'm not smart enough to do any of that trading stuff. Okay, so I think if you've got the dad joke locked and loaded, it's in the rocket launcher, ready to be fired out, I might go with the best name for this week who wins the Value Investor Program. I reckon here lies the prediction of rate falls in 2023 by Dr. Andrew Derrimouth, who I did ask about the Beta Shares platform. Love the name. I loved all the names, and thank you for the questions. Please keep sending them in. You can get in contact with myself on Twitter, Owen Rask, or you can just send in your feedback and comments. One thing I want to do a shout out to before we get to the dad joke, which is what everyone's hanging on for, is just that over the Christmas period, particularly in January, we're going to be doing a countdown of the best episodes ever across the Rask network. And so I would love your feedback. If you're on Twitter, if you've got 2 minutes, please help me out by sending in your suggestions of the best episodes ever. So well in excess of 500 now. What are they? Please let me know. Like, we've had some fantastic people on the show. Most of the people that listen to this show today would have missed so many of the fantastic conversations over time. And they're not just from Drew and I, of course, but of all the interviews we've done over the years. Like one of the wonderful ones that from many years ago went for almost 3 hours was Peter Pan, who runs Castlereagh Equity in Sydney. Wonderful conversation. Even the very first episode with Wayne was wonderful. Wayne Peters. So check out all of those and please let me know in the feedback. It would be I'd really appreciate it. So, all right. With all that said, Drew, from Wattle Partners, retirement specialists, financial planners, tell us more.
Sorry.
Yeah, the suspense is killing me.
Oh, I missed the end of your question there.
No, I was going to say, what is your joke for the week?
Oh, sorry. Already halfway out of the office. So this one was one that's very close to home.
Okay.
And that question is, or the joke is, I never liked facial hair until it grew on me.
That's not that good. It's not the fish in a riverbank type thing.
I was way off.
It always gets a laugh from me though, because I'm always like, I'm always preparing for something, and sometimes it doesn't land. Like sometimes it doesn't come, but that's
Did
okay.
not land at all. Can I try a second one?
Okay, go for it. Give us
I'm
another
getting
one.
desperate here.
Okay. Where are you sourcing your jokes from? This is probably the
You
number
don't
one
want to
thing.
know today. Not the normal place.
Okay. There is a wonderful, there is the fountain of dad jokes on Twitter at Dad
Here we
Says
go.
Jokes. What is it?
I was playing chess with my friend, and he said, "Let's make this interesting." So we stopped playing chess.
Yeah, right. Go and play with your Rubik's Cube. I think it's the message for today, because we're going to need to get that testing. Actually, I am going to get you a Rubik's Cube. It was your birthday the other day. I'm going to get you one. I'm going to bring it in the office, and we're going to sit down for an hour, and
You
we're
can
going to
film me. We'll do it on the next episode.
we'll do a live episode as you solve a Rubik's Cube. I think we can do that. Monique, I know you're not here this weekend to do the audio edits, but next week we're doing this. Well, Drew, this has been heaps of fun. If people want to get in contact with you, they can head to wattlepartners.com.au, or even better, there's a link in the show notes that says ask a question. Select the Australian Investors Podcast. There's another link in the show notes that says financial planning. Go in there and fill in your deets. Drew, pleasure, mate. Thanks for joining me.
Good to see you.